And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025. Good evening. Welcome to the program. 8 minutes after 6. I'm Stephen Grootes. Interesting to see news. I saw this on Fin24 that scooters, the pizza delivery service, seem to be coming back. They've got an outlet in Melville, I understand. They've sort of made this promise. It sounds almost revolutionary, but really is a sort of back to the future moment that your pizza will arrive within 39 minutes. And I was trying to think of how the delivery industry has changed since we last saw them. They disappeared, 2010, around there, a long time ago. Either way, the science and the business of delivery in South Africa has changed so dramatically since, I would say, the start of the lockdown, March 2020, call it there. I wonder if we're going to find that the economics for a pizza delivery company has changed dramatically too. I wouldn't be surprised if it has. I do kind of feel that some people have certain services, delivery services they know are incredibly reliable. They work all the time. I'd be very interested to hear your experiences of the Uber Eats, Mr. Delivery, Checkers 60, all of them. I've found some to be very reliable. I found one to just be disastrous, great for transporting people, terrible for transporting food. I don't know why, but just maybe it's where I live or something. I have no idea. And the other's kind of fine, really. Depends. I find in the end, often the restaurant that I'm buying the stuff from, if they have a delivery, I'll use that. And that tends to be the fastest. But I'll be very interested from you on your experience. It may well be where you live as well. 011-883-0702, 021-446-0567, and voice notes on 072-702-1702. Do you like to go direct to the restaurant, or do you prefer to go through another service like Uber Eats or someone like that? We'll talk about the economy and economic growth. Gina Schoeman suggesting, she's at Citi Bank, suggesting that, in fact, we won't get our economic growth of 2% for possibly the next 5 years, which is a long time if you think about it, a very long time of very low growth. We'll hear from Prof Adrian Saville on the subject as well. The big Coca-Cola bottler deal coming through today. Basically, the company that bottles Coca-Cola at the end of it will be providing Coca-Cola and all of the associated products, including water, I presume, for more than half of the people who live on our continent. It's an extraordinary deal on some levels. We will talk also about how many companies are losing out because of the US tariffs. And then I'm really looking forward to a conversation with Anders Curtin. He's the CEO of Fraser Yachts, lives in France, works in Monaco. They're not that far from each other. But there's a big African boating conference underway in Cape Town, looking at what's called the recreational boating industry. Let's call it what it is. We're talking about super yachts, really, in the main. We'll talk about that industry before 7 o'clock. Looking forward to that. And what would you put in your yacht? I know I kind of have a few ideas of what I'd put in mine. I'm working on it, and I'll work on it a little bit more through the show as we go. Gold plating, not my thing. In fact, that doesn't really need to be sort of plated. That's kind of not my vibe. I would certainly suggest, though, a bookcase in every single room of my super yacht. That would be my kick. What would be yours? 011-883-0702 and 021-446-0567.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, more cold water poured on our economic growth ambitions this week. Citi Bank joining the IMF in saying they don't believe we'll grow by 2% this year. And in fact, it looks like we'll stay below 2% for the next 4 years. That's until 2030. We start with Gina Schoeman, the economist at Citi Bank, who's made this forecast. Gina, good evening. A growth of below 2% for the next 4 years. It's quite gloomy. What are you basing it on?
Well, good evening, Stephen. Thanks for having me on the show. Maybe just to put that in context, at least it is on the way up. We are looking at 1%, 1.2% growth for 2025. The way models work, I would say predictive power is the strongest within the 3 years. And that means that over the next 3 years, we get up to about 1.8%, which really isn't too far off from that 2%. So where I would say forecasts depart from the IMF is that the IMF is always going to give you that much longer 5-year forecast. But we do also start to see more upside risk. from year 3 onwards. So that at least gives South Africa some realistic hope that if these structural reforms that we are currently embarking on actually perform, actually emerge in a strong enough way to convince the private sector to invest more, then sure, above 2% in 3 years' time is then more likely than what it is looking like now.
So is a lack of investment by the private sector the problem, and therefore presumably a lack of confidence?
I wouldn't say it's the lack of private sector investment that's the problem. The problem is that there isn't a strong enough or sufficient investment case yet in South Africa for the private sector to actually deploy that type of investment and be guaranteed on a sufficient rate of return on that investment. You know, if you just think about this in simple terms, if you are a company and you are looking to invest, you need to, have the profitability for that. You need excess profits. You need a lot of confidence that you're going to get that return on that investment. And then after all of that, you have to convince shareholders, whether you're a listed or unlisted company. And all of these things come together in a very difficult global environment. And yes, South Africa's done quite a lot of work to move forward in terms of its reform agenda. So we have to give credit where credit's due. But there is still more that needs to be done. And that is why the private sector has been the missing piece and continues to be the missing piece when you look at GDP growth. And that was the biggest drag on GDP growth in the first half of this year.
You suggest 3 years out, there's suddenly upside risks. What happens then? Just before an election? Is that the risk?
Well, yes, that is part of the risk. But let's also face it. You know, forecasts on a 3-year basis do kind of work in a vacuum. In other words, are we absolutely convinced that over the next 3 years, you know, there won't be some global cycle or some shock to the global system? No, no one ever sees those things coming. Models and forecasting naturally works this way. You see the underpin of the economy, and I would argue, in the last 50 years of looking at this economy, I haven't been as constructive on potential growth story for South Africa as constructive as I am now. But we don't have actual growth yet to give us that convincing, demonstrated track record that there is actually something emerging. And I think we've all been burnt, corporates, forecasters, on a lot of plans announcements that haven't really transpired too much. And we are seeing progress. These plans are resilient things, but it's still too early to say. Where I would like to be wrong is end up this time next year in 2026. We see that reforms have pushed ahead further, and then we've seen upside surprises to particularly private sector fixed investment, which means upside surprises to our growth forecast. Then, of course, we can go and relook at everything and maybe get above 2%, lot shorter period. But we must remember that as a small open economy, we're always going to have the global economy as a risk in the background. Sometimes it's a good risk, sometimes it's a bad risk. But with the current geopolitical backdrop and trade globally, things aren't really very promising from that perspective. So South Africa is going to have to work harder locally in order to push forward with its own domestic agenda.
Gina Schoeman, thank you so much. Economist at Citi Bank. Listening to that, Professor Adrian Saville is Professor of Economics and Finance at GIBS. Adrian, good evening. Do you agree with that? I mean, it really does point to a lack of confidence, and I suppose that's because there's been a lack of there's been some reform, but a lack of wholesale structural reform.
There's a critical ingredient that's missing in action, and that's gross domestic fixed investment. You can dress this up as much as you like. To be blunt, you can try and put lipstick on the pig. But until such time as South Africa gets into serious gross domestic fixed investment activity, the economic growth will be anemic. And, I agree with Gina. First, forecasting is overwhelmingly folly. There are so many things that can get in the way between now and then. And whether it's 1%, 2%, or 2 and a tiny bit percent, any one of those numbers just isn't of any real consequence in terms of broad-based economic upliftment that will move the needle on critical social indicators. starting with unemployment.
We talk about the private sector not investing, but it's also true of government, isn't it? It's not investing in infrastructure.
Yeah, both have been missing in action. Private sector have had their hands behind their collective back for some time, waiting for evidence that the public sector is going to start turning the words into action. And unfortunately, the way we find ourselves fiscally, that current spending has crowded out capital spending. It's going to be more of the same, this very, very limp, feeble, low economic growth that doesn't match or indeed surpass population growth. So we're stuck in this very feeble, low growth trap.
We're also at a point where almost no matter what happens, whatever a politician says, whatever a new president might say, people have been so disappointed for so long, they're not going to invest until they see real action. And that takes a lot longer.
Yeah, and there you sort of stuck in this, in this dilemma of, I'll go when you go, and looking who sort of goes first, your Mexican standoff, and there is, having said all of that, there is some silver lining to this rather weak outlook, and in particular the reversal in the energy cluster, that we've now got 400 plus days of uninterrupted energy. There are modest but important improvements in transport network, so those are valuable. All of that read against a backdrop of improved commodity prices. That's a valuable trifecta that plays in South Africa's favor. But more really needs to happen in order to start to see the needle move and us to get into elevated single-digit growth, the 3 and 4 that's necessary to move South Africa.
Professor Adrian Saville, thanks so much. Professor of Economics and Finance at GIBS, 20 minutes after 6.
7:02. Stephen is on X.
At Stephen Grootes.
22 after 6. Big news today in the world of Coca-Cola bottling. Coca-Cola HBC buying 3/4 of the company Coca-Cola Beverages Africa. The results will supply over half of Africa. Coca-Cola itself, moving away from owning its own bottling operations, provides the concentrate to bottling companies. They bottle it and sell it in different markets. David Shapiro is, as you know, the veteran stockbroker and chief global equity strategist at Sasfin. David, good evening. A big deal. It sees another secondary listing on the JSE. How do you see the rationale behind it?
It's very interesting, and I'm glad that it's going to have a secondary listing on the JSE. Stephen, this company, you don't want to quote too many numbers. It's very hard when you're listening to understand that. But this company together, as you mentioned, will be worth about 360 billion rand. And yes, it will be a secondary listing on the JSE, but what it will do will allow South African participants or, anybody around the world to buy these shares, on the JSE. So it's very important. And I think the reason they're doing it is because of the extent of the operations in Africa. The Grootes family, I think they're based down in Port Elizabeth or Quebec, if I'm not mistaken. They own, together with Coca-Cola, that's the American company, as you mentioned, they own the recipe, but they do allow, Coca-Cola owns a recipe, but they do allow other companies to, use that recipe. Still very secretive to bottle Coca-Cola and sell it. So they are selling, as you mentioned, to Coca-Cola HBC, which is Hellenic bottling company. It's an old company. It's been around for a long time and listed in London. So I think because of the extent of the African operations, they're going to make it available to, they want to spread ownership, I think, in Africa, and give Africans a chance to own this. And I think that's why they're coming to the JSE.
I mean, David, I'm no investment professional, as you know, but if you consider that this is providing a product which has been sold for over 130 years, that Africa's population is growing, that Coca-Cola doesn't just make Coke or Fanta or even Fanta Grape, they sell water too, you would think there's probably quite a lot of growth here over the longer term.
I think that's why they're doing this deal. And, I think Coca-Cola Hellenic, or HBC, which is has a very strong operation. And I think is going to consolidate this business and also probably expand it in a much greater, to a much greater extent. I don't know. I've met the Grootes family some time ago, but maybe there comes a time where they want to hand over. They still will own, they're going to swap their stake in this, in the African business for shares in HBC, which is the London listed company. So they'll still have a very good stake in it. But I think, handing over to the operation in Coca-Cola, in London, I think is just going to make it a much more powerful business. And as you say, I think it's a very strong operation and many, this huge population in Africa, and this is the ideal product. I know it's full of sugar, and I know there are going to be a lot of critics who say, don't pump the people full of sugar, sell them health drinks, but I still think Coca-Cola has an incredible brand presence, not only in the world, but to a large extent in Africa. Very, very powerful brand. So, I think it's a very good deal. We've been waiting for this for a long time.
I presume also, when you consider how big these companies are, I mean, they'll have to merge cultures a little bit. They'll imagine some of the systems will have to all be harmonized. I mean, there'll suddenly be quite a lot of work to do.
I think it's already there. I don't think this is going to be that difficult because of its Coca-Cola presence. Because it does Coca-Cola, Coca-Cola still keep a watch on all these operations. They don't neglect them. So I think it's a worldwide brand that have probably got standard operations or standard procedures. So we'll wait to see whether that happens. But the HBC company in London has extensive operations in Asia, in Europe, and in Africa. Very big in Egypt and Nigeria already. So it's incorporating this other operation. But you're right. These are, they're I think in 14 different African countries. Yes, so you've got to consolidate them, but are probably a lot easier than unknown companies. Good brand.
David Shapiro, really appreciate it. Thank you, veteran stockbroker, chief global equity strategist at Sasfin.
The Money Show.
The Markets.
Ryan Hill is the head of fundamental sales at Absa CIB. Ryan, good evening. A big sell-off in Foschini today. An update from them saying that their headline earnings per share will be down by around 20%, but still down 16% on the day.
Yeah, evening, Stephen. Not a good day for markets as a whole in South Africa today, but as you say, Foschini probably the biggest drop on the day. In fact, I think that's the biggest drop we've seen in Foschini in the last 5 years since COVID. And particularly their first half trading update, not looking very good. I think market was clearly expecting much better numbers. Much of the weakness seems to have come through in their South African operations, in fact, and they were suggesting that, margins were under pressure. They've seen some sluggish sales growth. There were cost pressures. And I think markdowns on inventory sales at the stores were certainly larger than they expected. There were also some financing costs, which I think surprised on the upside. So clearly market not very happy with those numbers. And in fact, in the process, also sold down some of the other clothing retailers as well. Those closed down between 3 and 5%.
Two big sell-offs in gold and in platinum today. First, let's just start with platinum group metals. I mean, the price was down significantly, but quite dramatic for the shares.
Yeah, those shares fell between 7 and 11%. I mean, look, I do think that there's been a phenomenon of late whereby all of the precious metals have been moving in tandem somewhat. In fact, I think that possibly what's been happening here is that it's ultimately the dollar that's basically been dominating these price moves. So as we've seen the dollar weaken, we've seen the price of gold, the silver, the platinum stocks, the shares as well, basically going up. And then today, for the last couple of days, we've seen the dollar actually strengthen, which is not exactly what consensus is expecting at the moment. And of course, you saw this dramatic move in the gold price, which then basically seemed to draw all the precious metal prices down. We can talk about, what's been driving gold specifically. As far as the PGMs are concerned, all three of the metals, platinum, palladium, rhodium, all three came under pressure today as well.
And gold, people not long ago were talking $5,000 an ounce. The underlying momentum might, I suppose, in some ways still be there.
I think, if we look at the fundamental drivers for gold, there's very strong central bank buying. There are very good fundamental reasons why it's likely that gold is possibly going to go higher. But as I suggested earlier, it's possibly the strength in the dollar which is possibly causing somewhat of a risk-off move there at the moment. If you think about the near-term effects, it's possibly the end of the buying season in India, the stronger dollar itself, the potential for positive trade talks between China and the US, some potential positive news on the geopolitical front. And so it's likely that you're seeing a bit of profit-taking by the retail investors in the gold space, but certainly central bank buying still remains pretty robust. So, maybe this is a bit of a pullback for now, but to your earlier point, I think there could still be upside for gold from here.
Ryan Hill, thanks so much. Head of Fundamental Sales at ABSA CIB.
WhatsApp Stephen
on 072
702
1702.
Well, we're talking a little bit about delivery services. Some people I know prefer to use the delivery that comes from the restaurant, so call it the McDonald's or the KFC or the Chicken Licken or whatever it is, or the Burger King. Others prefer to use your Uber Eats, your Mr. D. And this is all because scooters are back. They're promising deliveries within 39 minutes. As I say, the delivery industry has changed slightly since we last heard from them, I must just say, but your views on that on 072-702-1702. I noticed, and just picking up on Jacob Mashokwa's lead story about black economic empowerment in the EWN bulletin, this is all because of the DA putting out a sort of draft members bill that would end it. Two statements that I saw this afternoon. The one comes from government, and the headline is, BBBEE, in other words, broad-based black economic empowerment policy, is a critical policy of government. Doesn't mention the DA anywhere. Reaffirms that the broad-based black economic empowerment remains a key policy instrument of the state, central to South Africa's economic transformation, etc., integral to redress historic injustice, broaden economic participation, build a truly inclusive economy. Just goes on in that way. Nothing wrong with that, is what it is. The National Empowerment Fund, though, which is an institution of government, says the National Empowerment Fund notes the DA's, the Democratic Alliance's proposed economic empowerment bill. They say they welcome robust debate, how to strengthen and grow the impact of transformation. We outrightly reject the notion that removing race as a determining factor will advance inclusive economic growth. And they go on to talk about why we are where we are. And they say that their mandate, this is the National Empowerment Fund's mandate, is grounded in the Constitution and the Broad-Based Black Economic Empowerment Act. Now, people must put out statements. It's an argument that we must have. I think race is absolutely crucial to all of this. The argument is about whether or not we have race-based redress, and I welcome your debate on that. And that's actually what the DA wants, by the way. So they want a big argument about it. I was struck slightly by the tone of the National Empowerment Fund. They could have done what government did, basically said, we support this policy, full stop. Everyone knows what they're responding to. I don't know if I were an arm of government, if I would attack a political party so directly. It might be the EFF tomorrow, who knows? And you just end up down a rabbit hole. Anyway, your views on that, and the DA, of course, getting as much attention as they can get with their move to scrap broad-based black economic empowerment. I really do mean it. We do need to have a conversation. And I've been struck by one thing, and I've mentioned this to you before. I've been struck by how few people are defending black economic empowerment at the moment. Very few people are coming out, phoning and saying, I support it, I defend it. I mean, maybe people support it more quietly for some reason, but that's what's really surprised me in this debate. Your views on 072-702-1702.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025.
7 the time, we're beginning to get an indication of the impact of the US tariffs on different parts of our economy. And some numbers suggesting that the export of goods produced by small and medium enterprises here that are being exported to the US is down by actually over 45%. Aretha Cooper is the Chief Operating Officer at Tunnel, which has compiled these figures. Aretha, good evening. You say the volume of goods we've been selling is down dramatically. How have you been able to assess that?
Hi, Stephen. So Tunnel basically has a global shipping platform, and we've collated data from a fixed cohort of 1,850 anonymized SME merchants. So these merchants have been shipping daily on our platform, and we use this data and set a baseline to the week before the Trump tariffs were announced. And using this fixed cohort, we're able to see what the impact has been since those Trump tariffs have been announced and have come into effect.
Can you see which sectors are most affected?
That's going to be coming in our next press release. So we're busy working on that and hoping to have data out by the end of October to share with you guys to see which sectors are most effective. Our data set has about 12 different categories in it, so it's a pretty broad segment of data that we'll be able to share with you.
I mean, I presume it's a little early to know if this is a kind of once-off shock. People might also have been front-loading, so the customers in the US might have had enough stock, etc., or if this is going to be the longer-term impact. I mean, that's probably going to take quite a while to know.
Yeah, so definitely. I mean, if you check out our SME export index, you'll see that the data is quite lumpy, and there are times that we've actually seen increases, and that's where exports are actually getting stockpiled, as you say. And then earlier in September, we actually had a decrease of down to 60%. And that's, I think, where people were really hit by the shock of it. So that's the immediate impact where they're trying to figure out what should they do and how should they respond to this. And then we've started to see it improving a little bit toward the end of September. But this is a really early glimpse. So now is the time for South African merchants to pivot, figure out their strategies, and we'll be able to start to see what that long-tail impact is going to be.
There's so many different elements to it. I mean, I would imagine that other countries affected by the tariffs as we are, some more, some less, most less, are going to have the same impact. I don't know if you've been able to come across similar indices in other countries that might tell us how we are doing compared to other places.
That's not something we've specifically looked at, but definitely something we should get into. We obviously know there's stories coming out of Lesotho where, industry's been devastated and lots of jobs have been lost. So I think it's definitely a global macroeconomic trend that we're seeing. South Africa is not going to be alone here. And similarly, most governments are responding, trying to see how they can negotiate and where they can win points for their SME merchants.
So many people are looking for other trading partners to draw up an index to sort of see where goods will go otherwise, a bit more complicated. You'll probably need a lot more data. But I imagine that's one of the questions you'll be asking. I mean, have you found another market? And that can take quite a long time. It doesn't just happen overnight, as we keep being told by government.
Yeah, so I know government is pushing people for market diversification. So that is definitely important. And we have seen some of our merchants start to pivot to that already. So some merchants already started telling us as soon as the announcements were coming out, before the impact was felt, that they were moving their marketing budgets to Europe. So we see people shifting to the UK, EU, and Australia a lot. And that's specifically for South Africans great markets because there's generally South African expat communities who are more friendly. It's a great way to start building the brand. But as we know, that doesn't happen from scratch overnight. It has to be built up. It takes time. And so there's a long tail here. And also, Stephen, some merchants can't just simply switch. If you're using a platform like Amazon, Etsy, or eBay, the US market is hard to walk away from. You've built momentum. Those platforms are built for that market. So it's hard to just pivot. What you've built on Amazon US doesn't just translate to Amazon UK.
Yeah, no, absolutely. I suppose the other question is that these are smaller firms. Bigger firms might have a bit more of a marketing budget, might be better able to pivot, although the bigger firm often the less agile it is too. But this might be an indication of what's going to happen across the board for South Africa.
Yeah, so that's a good point that you make. So our data set, we feel is important because it actually speaks to the smaller merchants. So there's normally data on bigger industry, but here we have businesses that range from a single individual who's selling their product. So they are the marketing, they are the manufacturing, they are the person booking the shipment, packaging it, up to businesses who have more than 100 staff. And so we think that this is probably going to be representative of what's happening. As you say, the bigger companies have more reserves, so they might have more profit in the bank to weather the storm while they figure out what's going to happen. But I think this is probably indicative of what we're seeing across the board.
Aretha Cooper, thanks so much. The Chief Operating Officer at Tunnel. Really appreciate the time. You're one of the companies affected by the US tariffs. Good to hear from you tonight.
702.
702.
Stephen is on X.
At Stephen Grootes.
Well, underway in Cape Town today, goes into tomorrow as well, the first African boating conference, essentially a gathering of the recreational boating industry. I suppose you probably want to think of big yachts, maybe super yachts, in fact. And this is the conference where the people who make those things will actually be. You may remember we actually have our own industry, primarily in Cape Town, that does supply yachts to some of the, how do I put this, people with a little bit more money than most of us. The CEO of Fraser Yachts, one of the biggest companies in this field, is Anders Curtin, and he's here for the conference. He's in Cape Town now. Anders, good evening. I do appreciate the time, and thank you. You've been in the yachting industry for quite a while. You've worked in it actually building the things. You're the CEO of Fraser now. Is business pretty good, or is this a difficult time for your industry?
Well, first of all, Stephen, thanks for having me. It's great to be here, both in Cape Town and on your show. I would say that the last 2 years have actually been pretty good for the super yacht services industry where Fraser operates. And mainly we do yacht brokerage, which is helping clients buy and sell these assets, and then charter, which is sort of, selling the dream in bite-sized pieces, if you will, of 1 week, 2 weeks, 4 weeks, 6 weeks, whatever. And then additionally, yacht management and crewing these assets. So both 23, 24, and 25 have been good years, and it's looking like it's going to continue.
What gives your industry that kind of momentum? I mean, I imagine that this is, your customers are not necessarily people who are affected by economic downturns like most of the rest of us.
Well, I was actually on stage last fall in Amsterdam at an industry event, and one senior pundit in the industry, he had been spending sleepless nights wondering about what is the drive that makes people want to own or charter something like super yachts. And you might easily imagine that it has to do with, living in the lap of luxury or waking up in different epic destinations of your choice every morning during your vacation. And while all this may be true, what he found in his qualitative research was that the answer is actually far more simple. What unites both the charterers and yacht owners is a deep and profound love for just being at sea. And, this dream, which in many ways represents sort of the ultimate personal freedom, that is something that seemingly continues to resonate from year to year. And if anything, the pandemic sort of brought that even more into focus, because what's a more safe and better way to spend time with family and loved ones than to be on board a yacht?
It does make sense. I mean, are there a lot of super yachts being added to the fleets every year? I mean, is this an industry where you see maybe 1 or 2 or maybe 10 or 20? I can't imagine you get thousands of new super yachts on the seas every year.
It is a fairly niche industry, and new yachts over 30 meters are added to the fleet to the tune of about 200 every year. And the existing super yacht fleet, 30 meter plus, is about 7,000 yachts. But what's fairly interesting is that there's virtually no attrition at the older end of the fleet. A well-built yacht doesn't really have a best before date. And typically, as the technology on board and maybe the propulsion, the engines, or the rig, if it's a sailing boat, grows older, then you just replace that during a major refit. So we have yachts in the fleet that were built in the early 1900s.
And I would imagine, in fact, the age might make them worth more.
That depends. Usually when asked whether this is a good and sound investment, I answer yes, it is, but the return generally is more of the emotional kind.
I can see you've been in the business for a while, Anders. What is it that makes one yacht better than another? I realize size matters. I'm sure the size of the engine matters. But are there certain features to a super yacht that people are really keen? I mean, I hate to be so banal, but does it have to look good on Instagram for it to really sell?
Well, I think, you touched upon the sort of fundamental reason behind why it is like it is, and that is, we operate in a universe of extreme scarcity. Now, these 7,000 yachts in the fleet that I just mentioned, they're almost all sort of different from each other. And the owners and the charters, they are for sure, in many ways, one of a kind. So there's really no sort of cohesive answer to that question. It really depends on your use case. Now, if you were to endeavor on a certain navigation of 3 years with your family, you'd choose a very different type of boat than if you were to embark upon a 1-week island hop vacation, for example, in the Mediterranean. So everything is really driven by how do you want to use the boat. But one thing, if we look at what's changed over the last 10, 15 years, is that today, especially the younger generations who have emerged both on the charter and owning side of things, they do expect to take their onshore lifestyle seamlessly on board. So it's maybe a little bit less about the yacht as a technical object and a little bit more about where can it take you and what kind of experiences can you share on that yacht, and more importantly, with whom.
Cape Town has an industry that's part of this. Do you think there might be some room for Cape Town's yachting industry to grow? I realize that, products made in Cape Town might be hit by American tariffs. But is there much space? I mean, what would your advice be to what is quite a niche industry in one part of our country that is quite far away from some of the major markets?
Look, I usually say that for super yachting to really thrive, you need 4 things. You need history, you need culture, you need infrastructure, and you need destinations. Now, history and culture will come as a function of time. Infrastructure can be built if you know what you're doing and have the necessary resources. But if you don't have destinations, it's really hard to create a thriving super yacht ecosystem. But South Africa is extremely lucky, and the whole African continent actually, because you have epic destinations. And there's always a certain subset of both yacht owners and charters who want to sort of venture further, not necessarily where no man has ever gone before, but where the masses aren't yet. So I think there's huge upside potential here. And once you start focusing more cohesively on the epic destinations that you have, the history and culture will follow as a function of time.
Your predictions for the next couple of years, then, you're pretty optimistic clearly for your industry.
Well, look, we sometimes, when we do speaking engagements, such as the one I have tomorrow, take the example of charter activity in Greenland. A couple of years ago, one of the trade magazines had a big article about, charter activity in Greenland is exploding. It had increased by 700%. That's because 3 years before that, there was 1 yacht there, and the year before there were 7 yachts there. So when you start with limited numbers, it's easier to get to exponential growth. I think there's certainly a lot of upside and room for growth for Africa as a both charter and a super yacht owner destination.
Anders, I really appreciate the time. Thank you. Anders Curtin is the CEO of Fraser Yachts at the boating conference, the African boating conference underway in Cape Town. You with The Money Show. Happy sailing. It's 7 o'clock.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the Absa Africa Financial Markets Index 2025.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
Good evening, I'm Stephen Grootes, 7 minutes after 7 the time. Plenty coming up in the next little while. We'll speak to Seitati Bolipombo, the Chief Commercial Officer at Molilo. We'll talk about electricity, energy, and 230 billion rand. I'd like to think that even our energy sector could do something constructive with 230 billion rand. But there are times when I wonder, because the scale of the numbers is just so massive. We need so much investment. Rotendo Hundwengwi, he'll be around in a few moments. We'll update you on what's happening on our continent. And don't forget Warren Ingram tonight. He'll be looking at the issues around being an entrepreneur and your personal finances. You've got to separate your finances from the company. And yet, if you own the company, and if the company is you, not actually that easy to separate. Looking forward to your calls, too, on 011-883-0702 and 021-446-0567. Some WhatsApp voice notes coming through about the delivery service that you prefer to use. A couple of people talking about BE as well, and talking about how it is that you can actually manage that. The DA, as we know, bringing bills against it. Lots of responses to that too. I will also be interested in your views on the future of drinks like Coca-Cola. At one point, it seemed that the kind of idea of a sugary drink would just go away. And I must just tell you that when I was younger, I used to drink a lot of Coke, maybe one a day. Now the sugar's too much, unless I've been doing some pretty serious exercise. So, a long cycle in my case, because running and I are not mates. And then I'm quite keen on some Coke. Otherwise, not very keen at all. Anyway, voice notes coming through tonight on 072 702 1702.
Hi, Stephen and the team. With regard to the so-called triple BEE, I don't think that it should stay. Why I'm saying this is that companies are now going for what is called BEE partners, the likes of Shanduka Group, and then who owns the Shanduka Group. So then you'll find out that the small network tend to benefit on these BEE. So they're no longer going for David on the street, but they go for so-called BEE partners. And these are companies with nothing to offer, just waiting for BEE partnership. David.
Yeah, David, thanks very much. Yeah, look, there are so many issues with the way in which it's worked out. And the argument then starts, well, what would replace it? Well, there is the offer from the DA on the table, remove race-based redress from it. I must say that doesn't sit very well with me. I think that you do need an element at least of race-based redress. I know not everyone agrees with that. I know plenty of people. In fact, I have a lively correspondence on the subject on email around that. Plenty of people oppose that, and I can understand why too. But I made the point earlier, there are very few people, who seem to be coming out and willing to defend BEE or broad-based black economic empowerment one way or another. I just don't get many people who get in touch one way or another and say, I defend it, and this is why. And I do think we need to have a proper debate on the issue. 10 minutes after 7.
The Money Show.
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
And DSTV channel 856.
Well, some reports coming out that the EU's agreed to make up to 230 billion rand available for our clean energy transition. That should make it easier for independent power producers to get up and running. Say Tati Bolipombo is the Chief Commercial Officer at Mulilo, the energy company. Say Tati, good evening. Thanks for the time. It sounds like a lot of money. I imagine there are strings attached, and this is financing that is supposed to achieve a particular purpose.
Yeah, good evening, Stephen, and thanks for having me. Certainly large numbers that are being touted, and I think large numbers are critical for our just energy transition as a country. I think it's also a timely announcement given the recently published IRP, or Integrated Resource Plan, by the Minister of Energy and Electricity. And if you look at the ambitions around that IRP going all the way into 2040, those are serious gigawatts that the government is intending on investing or building out in terms of generation. And so you do need numbers in the billion to support that build out. And then in terms of the T's and C's, I guess time will tell.
I imagine the next thing is who decides where the money goes. There'll have to be quite a careful process around that. Lots of companies will be looking for a little bit of that financing.
Yeah, indeed. I think, that is probably, it comes down to political officials in terms of where that financing goes. But I think if you even just consider our own transmission infrastructure plan and infrastructure build out to South Africa, again, in order for us to build 14,000 kilometers of transmission infrastructure lines, we require significant investment, and also at the same time, in order to generate those renewable energy electrons, significant check sizes there as well. So my expectation, at least our outlook as Mulilo, is that these are the types of funds that go into facilities that support, the independent power producer office, support the government auction program, both for battery energy storage and as well as the procurement of solar and wind from private sector. So I think certainly this contributes, and it will go a long way in terms of our just energy transition. But I believe that companies such as ourselves and others will still need to kind of fill the gap and partner with the government,
Is there a particular reason why South Africa is such a focus for these funds? We've seen other funds as well. Is it perhaps because if you look at Africa, we produce such a big percentage of emissions from electricity produced from coal?
Well, I mean, yes and no, but I think if we just consider why the EU is making this investment, and also why now, and that comes down to shifts in global or geopolitical headwinds and tailwinds and so on. I think there is more and more of a push towards the EU seeking credible long-term partners in the global south. And South Africa is the most industrialized economy on the continent. Yes, we have our challenges in terms of economic growth and so on and so forth, but we certainly make a good potential partner for the EU. I think also for us, it is strategic. Again, it supports our transmission infrastructure, it supports our renewable energy build-out, it supports our industrialization agenda as well as a country. So I think it makes sense for both parties, and whether it actually achieves the intended objectives, again, it's a function of time, right, Stephen?
You talk about the IRP released on Sunday. We talk about this money. I mean, I get a sense that, things moved very quickly at one point. And they moved very quickly because load shedding was stage 6 kind of all the time. And it seemed that we kind of, to use an interesting analogy, took our pedal off the gas a little bit. Do you get a sense that things are still moving quickly? I mean, the IRP, I know the headlines were around nuclear, I understand that, but there's a lot of solar and a lot of wind in there too.
Yeah. I think certainly our view is that there is positive momentum in the right direction. I think if you look at the IRP, certainly coal is still necessary, but we're seeing a reduced contribution in terms of its prioritization in the IRP. Massive, significant numbers for solar PV and wind, as well as battery energy storage solutions or systems. So what that tells us, at least as industry participants, is that there is still a political and a policy intention to support renewable energy generation build-out. That's positive momentum. I think also we know that the independent transmission program was recently released. We're waiting for the results of those initial requests for interest, and that's also, again, positive momentum in the right direction. So I think a lot of work probably happening in the background that doesn't quite make the headlines. But yeah, we're certainly confident of where we're going with in this space.
Setati, thank you. Setati Bolipombo was the Chief Commercial Officer at Mulilo, 17 minutes after 7.
The Money Show, Africa Business Focus.
Dr. Rotendo Ndengwe is the founding director of Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded, which is an interesting anniversary this week, if I remember. Rumble in the Jungle, wasn't it this week? In 1974. Bongani was talking about it.
Was it?
I think it was
God
this week.
Bless his cotton socks, Bongani, for reminding me.
Indeed. Don't get him in the ring. He'll punch you. Okay. Côte d'Ivoire, the Ivory Coast. They're tracing 40% of their cocoa. You're going to have to explain why this matters. This is about a point of origin thing, right?
It's a point of origin, but more specifically, if you want to import into the EU, Stephen, with regards to things like coca or anything related in the agricultural sector, one of the requirements is that you need to meet a certain level of traceability. And this traceability is linked to two components, Stephen. One, the land which the cocoa is coming from must be seen as being not impacted by deforestation since 2022. And then the second thing is that it has to be traceable back to its source of the origination of the cocoa product, and highlight that there's no deforestation. So it all boils down to deforestation. But why is this relevant to Ivory Coast? Ivory Coast has been able to, I think, of the 1 million cocoa farmers, Stephen, 900,000 of them, they've been able to give a digital link. So it helps in terms of traceability, but it's only 40%, and the target, I think, is closer to 100%. So on one side, they've made some good progress, but the challenge is still that they still have to go a long way. Just to give you the value of impact on cost, because remember, most of the cocoa farmers in Ivory Coast even are SMEs. So the average price of cocoa at this point in time is about $4 per kg, and the cost of this implementation of software of evaluating the whole value chain comes to about 10% of that, which is $0.4 per kg. So it's expensive on one side. It's necessary, but it talks to the whole thing of adaptability, cost, and viability of aligning to global standards from an African perspective, Stephen.
I mean, you wonder with chocolate prices the way they've been.
Yeah.
I wouldn't be surprised if someone tries to undermine this just to make it cheaper. Watch, amazing what people do.
Very true.
Nigeria and rural digital commerce. What are they looking at?
So Jumia, Stephen, I mean, is a big e-commerce player. It's gone through its ups and downs with regards to developing and growing on the African continent. But a recent report that they did highlighted that they're actually making significant inroads with regards to penetrating the rural client base. And just to give you some stats from a broadband perspective, 50% of Jumia transactions come from the rural areas. Nigeria, remember, which is their big market, and I'm talking about Nigeria as a country, 142 million internet subscribers, and broadband is about 46% penetration. So there's a huge penetration of technology and internet in that space. But 50% of the Jumia transactions are from the rural areas. And why this is important for them is, one, it creates another open market that they've been trying to target. What's driving this growth, Stephen, is logistics and also end-to-end inclusivity with regards to women, young people in the rural areas are actually embracing technology and using it as a means of not only jobs but also entrepreneurial growth. So that's the positive side of it. I think the challenge, Stephen, that I always have with regards to digital penetration in the rural areas is that how much does that really translate into infrastructure development? It's all good and fair that you've got technology infrastructure happening in the rural areas, but there's the issues that does this translate to better water? Does it translate to optimized agriculture? Does it translate to a lot of the health needs in terms of outreach, etc., etc.? So for me, this is great from a technology investment, e-commerce growth in the rural areas, but the big worry is obviously how does this translate to other basic needs that Africa needs in the rural areas to get them into a better society.
And I mean, also you want to, if you've got internet in a particular place for transactions, you'd like to think that there's internet too for the local school next door to it. I mean, that's how it must work.
That's how it must work, Stephen. So it's a bit of a bittersweet story when you hear these reports, because they say from a corporate perspective, from a penetration perspective, from a technology perspective, it's all good and well. But at the end of the day, in terms of the broader aspects of economic positive social impact, the concern is always, are we moving in the right direction? And I think with Nigeria, a huge economy, probably one of the top 2 economies on the African continent, infrastructure is still a big challenge, especially when it comes to health, it comes to education. So you're wanting that balance, and it's not just relevant to Nigeria, it's all across Africa. We've got huge internet penetration, Stephen. I think one of the figures I always throw around, Stephen, is that by 2029 there are going to be an additional 400 million internet users on the continent, but our GDP growth and our well-being in terms of health and infrastructure is all still lagging behind. So you want that balance, and you want that balance in a positive sense.
And then the Grand Ethiopian Renaissance Dam, and this is such a big issue because it basically dams the Nile, and that has a big impact on Egypt in particular. There's an Egyptian singer, by the way, who was jailed because she insulted the Nile in a song.
Oh, did you?
Yeah, I mean, that's how important it is. They've won American backing for a technical fix.
Yeah, so you remember the issue with Egypt and Ethiopia. I mean, obviously, even before the dam began, there was always a big fight between them. And America had taken a different stance at the time. But now they've come in terms of supporting Ethiopia, but with a more technical solution. And when you look at this, I mean, from a geographical perspective, it's not rocket science. You know, the water starts upstream in terms of Ethiopia and goes down to Egypt, and Egypt obviously has the concern in terms of who controls what, and you guys have the power, and that's where the fight began. But what are the technical recommendations that America is bringing to the solution? Because this investment was about $5 billion US, so it's a big thing for the African continent. The technical fixes are one is water release management. So just in terms of let there be agreement and structure with regards to how much water is released down Nile and the impact that has. Data transparency. Data is power, Stephen. So what does that mean? It's just in terms of analytical information with regards to the usage and all the data that's related, or the analytics that related to that. Reservoir filling, and as well as addressing climate uncertainty. So not a lot of detail was given in the report, Stephen, but ultimately what America is coming as a big brother into the African space is saying that, look, guys, let's look at the pros and cons of this. There is total value for both countries if they apply their minds and look at the technical solutions with regards to this and how to navigate it. So it's a step in the right direction. The question is, how will they both embrace it? And I'm talking about Egypt and Ethiopia with regards to an ideal solution going forward.
I mean, we need to talk about fashion because you and I are experts, but we're joined in a second by Aubrey Masango, so I think we'll be okay. And this is about people who are involved, this is in Kenya, in trash fashion. Now look, a black rubbish bag, very slimming on me.
So trash fashion, the challenge in Kenya, Stephen, is that every year they receive about 185,000 tons of second-hand clothing from China, the US, and 80% of that tonnage actually goes into waste. So second-hand clothing goes into waste, and it either ends up in the sea as pollution, or on the streets, or overstepped in the dustbins. So there's an entrepreneur who's come up with a brilliant idea to say, guys, one, let us see how we can redesign and recreate this fashion and actually create a different market, not only from a clothing perspective, but in terms of second-hand material. And they've created a fashion show for second-hand clothes, and it's actually picked up quite nicely. And I think the marketplace in Ethiopia, in Kenya, Stephen, is called Gikomba, where this is going as a trial run. And for me, it's a positive sign because I think you won't stop second-hand clothes coming into Africa. Just some key stats in terms of the quantum of second-hand clothes in Africa. It creates an employment base of 1.28 million people. And believe it or not, $73.5 billion US of tax revenue comes out of second-hand clothes. So it's actually quite a sizable industry. The question is, can you and I buy clothes from a second-hand fashion show? And that's a space for you, myself, and Aubrey to maybe try and experiment on.
Would anyone notice? Dr. Rotendo and Dingwi, you guys have the same hat supplier, though.
We're twins. We're twins. I'm the good-looking twin, and Aubrey's the better-looking twin.
Well, because we buy from that second-hand fashion place.
Yeah, that's a good answer. That's a good and safe answer, Steve.
They don't actually need me anymore. Dr. Rotendo and Dingwi, thank you. Founding Director of the Tribe Africa Advisory, author of Rumble in the Jungle Reloaded. I checked, by the way, Rumble in the Jungle, the first one was actually 10 days from now.
Okay.
In 1974.
1974.
I wasn't around. But, you know, otherwise I would have been the one stinging like a bee. 28 after 7.
The Money Show.
Personal Finance with Warren Ingram.
Well, Warren Ingram, as you know, is a certified financial planner at Galileo Capital. And tonight, we're talking, I suppose, about personal finance if you are an entrepreneur. When do you invest? When to invest your money or reinvest in your business? And so often, Warren, good evening. So often, if you are the entrepreneur, you are the business, and what your money is yours, but it's also the business's.
Good evening, Stephen.
Okay, so you're an entrepreneur and you're so used to managing your money for your business. You live, breathe, eat, sleep your business, but you really shouldn't be doing that with your money. How do you sort of navigate that tension?
I think we should probably break it up into different stages of the business's life. When you do financial planning, it's very natural to plan according to your own life stages as a human being. And I think it's, there are big parallels with the company. So to me, the first stage, and I'm sure the entrepreneurial academics would have, fancy names for these things, but I just want to call it the survival stage or survival phase. And that's when you've just got started and you're doing everything you possibly can to get your business going and keep it afloat and, potentially going from day to day or week to week, month to month. And there is going to be no money. There's going to be no extra money to pay yourself probably not even to pay yourself a decent salary. Forget about drawing dividends and paying out profits and all of those things. So I think in that phase, the only thing I would say is you want to make sure that your personal finances are as simple and as stress-free as possible. And that really means make sure you don't have, debt. So you don't really want to be suffering under the load of a credit card or personal loan, overdraft, etc., and trying to keep your business going. So if you're not able to look after yourself financially in terms of saving for your long term and saving for the future, that's okay at this stage of the business's life. But you really don't want to be making short-term business decisions because you've got bills to pay on your credit card at the end of the month. That could lead to bad personal finance decisions, but also very bad business decisions. So no rocket science on survival phase. It's just keep it simple, keep yourself debt-free, and give yourself kind of breathing room financially just to get the business going and hope that you get past the survival stage to the better days.
The thing about the survival phase is, in a way, strangely, it might actually be one of the more simple phases because you're just starting, so there is so much to do. But you hope and pray that it doesn't last forever. And once you start to establish yourself, the dynamics around it all start to really change.
Yeah, then it's the equivalent of becoming adulting for the first time in your business's life. And the first thing you've got to do, and it's quite difficult for entrepreneurs to do this. I mean, I know from experience when we started our company, but you have to start paying yourself a market-related salary. And it seems like such a strange thing to do because you might be the only owner of your business, but there is someone saying to you, pay yourself a salary. But it's important because you don't really have a viable business if you're not drawing a proper salary for yourself. If the business can't afford to pay you, and I'm not saying an extravagant amount of money, but just what you would earn for this kind of a role in another operation, then you're not at the establishment phase. So kind of after survival, you get to this establishment phase, and the real test here is, can you pay yourself a salary? If you can, and it's market related, then it's time to kind of clean up all the things that you might have let slip while you were in that survival phase. In other words, make sure that you've got a proper medical aid, make sure that you've done your life assurance calculations so that your loved ones are okay if something happens to you. Surprise, surprise, I'm going to tell you to build up your emergency fund again. If you used your whole emergency fund to look after the business, now is the time to get that going for yourself. And then maybe the last point on this stage is start doing a retirement fund contribution. And if you can't do 15% of your salary at this stage, that's okay. But just start something, even if it's 5% a year. And my logic here is you need to start treating yourself as, a valuable asset to the company, but also that you're trying to build up and maybe rebuild a little bit of your personal finances that are entirely separate from the business. We always need to plan for things to go well in the company, but equally you need to plan just in case things don't go well in the business. And that's why you start to pay yourself the salary and get your personal finances back on track again.
I've often thought a little bit about the idea of the market-related salary. It must be quite hard to know what that is. I realize you can do some research and you can look at adverts and things, but if you're the owner of the business, it's personal, and the business, it's many things, but it's also for you. So to come to the right amounts, the market-related salary, should you ask someone else to do that for you, maybe?
I find there maybe a few ways. One very nice asset test for you as a business owner is if you're the business owner, which means that you do anything and everything to keep the business afloat. But there will be the core job, the thing the reason you started the company. And if you were to hire somebody to do that core job, so not to be the chief cook and bottle washer and all the other things that you have to do as the entrepreneur, but the actual core job of whatever it is that you do in your business, then it's understanding what salary would you pay that person to do that job. And you might have come out of a very senior position, doing the job yourself before you became the entrepreneur. And it's maybe not necessary that you would pay yourself the senior person's salary, but just to kind of do that replacement. And then I think, you can look around and you can ask someone for help, but equally nowadays, a lot of these, these kind of jobs are available, or the data around these jobs, and especially the salaries, are available online. So you can find salary surveys and the like. But if you can't get any data, then certainly, maybe pick up the phone to a recruitment agent or two and ask them, what these jobs are paying. But I find they all advertise, and often they give you salary bands. So certainly when you're small as a business, you can't really afford to pay a lot of people for a lot of additional data from the outside. So use what's free and use the internet to help you with this.
I mean, the other thing is, and I'm sure I can just imagine the debates that you would have internally, is how do you know you're no longer in survival, but you're now in established stage? And I think a lot of small business owners don't actually sleep very well for quite a long time when they start their business.
I think that's a very true statement, and it seems to be this sort of anecdotal thing of 1,000 days, and to me, that's roughly 3 years, but probably somewhere around 3 to 5 years before you start to feel that you are past survival, and I think it's when you know that you can go to sleep at the end of at month end, and know that when you wake up next month, the bills are going to be paid, that you're not just scrambling to make ends meet every week or every month, and also that you're starting to think about extra money that's coming into the company, and you're starting to try and think about, where do I allocate the money to grow my business in the right direction? So it's not just I have to pay the bills to pay the rent and to pay the few staff I've got. Now you're starting to say, should I take on more premises? Should I buy another machine? Should I start advertising? All of those are growth decisions, but they're not survival decisions. So it's a very good sign that you're moving in the right direction, but you're thinking about how to allocate money best. And then I'm probably landing at this established phase now and past the survival phase.
It's such an interesting conversation to have about how do you know at which point you are when you're running your business. I mean, it's not an easy thing. Okay, so we move from the kind of established phase, and after that you get to the mature phase. So the business is, I suppose, running itself a little bit. What do you need to do then?
This is, if you had to draw a parallel, this would be the equivalent of someone in their career at somewhere around the age of 50, between 50 to 65. So you've done a lot of the school fees. You know what you're doing. You've paid, you've had all the valuable lessons you need. You're still learning and you're still growing, but you are in a stage where you can kind of stop and smell the roses a little bit and do a little bit of planning. And I find for entrepreneurs at this stage, they start to look at their business a little bit differently, because in the early days, in that survival and establishment phase, it's all about just getting the thing going and keeping it afloat and then, making it grow. But when you get to the stage where your business is a bit more mature, it becomes a double-edged sword, because most likely it's your biggest asset. It's the thing that you are going to have to sell or do some kind of a financial transaction so that you can draw some money out of the company, that when you no longer work in the business, you're able to live a good life, in retirement. And so you look at your business and you say, great, it's my biggest asset, But equally, that means it's also my biggest risk because I've put all this effort and all this time into it, and I haven't drawn, lots of money out of the business and paid myself, big bonuses, etc., to get the business going. So if it fails now, before I've had a chance to do a whole lot of investing and saving outside of the company, I could be in real financial difficulty. So you start to look at your business quite differently, and it's probably a very good stage to look at saying, what can I do to build up assets far removed from my company? And, that means you start to have conversations with the accountants where they tell you about things like dividends tax, and then you're going to be really upset that you're paying extra tax to take money out of your company. But when you're at that stage, you're finding good ways and the most efficient ways to start paying yourself, maybe extra money over and above the market-related salary, so that you can protect and insulate yourself from the business in the event that something goes wrong. And so it's not a case of trying to allocate money to something that will grow faster than your business. Most likely, if you've got a successful company, it's the fastest growing asset that you have. What you're doing is you're looking at this and saying, how can I manage risk? How can I de-risk my overall financial plan? So it's almost, I'd call it your banker money. So you're trying to, put money in global markets, or, if you're, whatever your business is, you're investing in things that, move in a very different way from your company, so that if something goes wrong, your investment assets are not as affected as your business assets. And so this is risk management, de-risking, proper adulting and financial planning. And your aim here is not necessarily additional wealth creation, but it's certainly to try and buy yourself some peace of mind and, get that sleep at night factor now that your business is in the flow.
There obviously is an exit stage. We're going to come to that in just a moment. We have a question from Ntaba saying for you, Warren, saying, hi, my employer just offered me a salary increase of 3.1%. He says that's slightly higher than inflation, but my expenses are growing so quickly. Is this increase fair? Ntaba saying it's a great question. I mean, what was it? Appliance inflation is negative 5% or something if you're buying an air fryer. But your food inflation is much higher than that. Your medical aid inflation is way above inflation. So on top of saying, I think your question is such a good one. We'll get an answer from Warren in just a moment. 9 minutes there.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the Absa Africa Financial Markets Index 2025.
The Money Show.
Personal Finance with Warren Ingram.
Talking, of course, about your personal finances as an entrepreneur. But before we get back to that, Warren, in Tabaseng's question, my employer's offered me a 3.1 salary increase. He says that's slightly higher than inflation, but my expenses are growing so quickly. Is this increase fair? And Warren, I suppose your answer may lie in whether you're in Tabaseng or her boss.
It's such a tricky situation. I think, we maybe just need to explain a little bit about CPI because, this number gets calculated by the Stats SA people, so there are a bunch of very clever economists that put together this measure of how the cost of things is moving from one year to the next, and they do it month to month, and everyone says it's probably manufactured, and probably a lie, etc., and they get all upset with it because they look at their own cost of living and it doesn't reflect what's shown in these official numbers, and I think just to understand that CPI number or that inflation number, it's the most average basket of goods for the most average South African there is. And unfortunately, that person doesn't really exist. So each of us spends our money in a bit of a different way from everybody else. And depending on the income that we earn and the assets that we have, our expenses might be hugely impacted by the price of fuel, for example, because for some people, and a lot of people in our country, would spend a huge proportion of their salaries on transport. But if you're retired and you don't spend much on transport, you might be much more affected by medical inflation, or all of us would be affected by food inflation. So I think just understanding that, that number, whatever it is, I see, in June it was 3% and then it was 3.8 and now it's come down, and it will move from month to month. So is your employer doing you in? I don't think so. I think, if these were calculated at the time and they used the most recent CPI number and they do that at the same month every year, then they're not trying to manipulate the game. But if you're measuring your cost of living and let's say medical aid is your biggest cost, and you say, well, hang on, that's somewhere between 6.8 to 8.5%. I'm actually going backwards. I get the argument. I think it's a fair point to Ntabi saying, but very difficult for employers to increase salaries at let's say 8 or 10% a year, when potentially their own costs are on everything else are also going up, and so you could end up giving what you think as an employer, you give your staff a fair increase, but you give your staff these increases for a few years and you run out of business. You don't make profit, and eventually you make losses and you go south. So I'm sitting on the fence, Stephen, because I think it's such a phenomenally difficult issue, and the only number we've all got is the CPI number, and I think it's perfectly incorrect, but it's probably the best thing we've got as a country.
Okay, let's just return to the entrepreneur. It's a great answer you've given, Warren, because it's very difficult. Let's just return to the entrepreneur and your personal finances. At some point, you need to exit the business. You're hoping things have gone well, that it's sustainable. You do need to sort of manage your finances at that point too.
You do, and I think it's just understanding that you might plan to run this business until your last day, and that's fine, but it's still, something needs to happen to the company when you're not around. So you might decide to retire from the business, or you might decide to sell it, or you might be hoping that someone will take over, one of your family would take over from you. In all of those, there will be a transition. There'll be a transition of management. There'll be a transition of ownership. And it's your job as the entrepreneur to get the business ready for sale. Even if you're not planning to sell it, you need to know that there is going to be a change of ownership. That means you have to make sure that your books, your accounts are easy to understand, and that everyone knows what's going on.
Was initiated by the fund in 2020,
and you know exactly where everything is, and someone else knows where everything is as well. So you've got to get the business sale ready.
All right. Sorry, I'm not sure, Warren, where that interference is coming from. Sorry about that. That is quite weird. We've pressed lots of buttons to get rid of it. I hope we haven't got rid of Warren Ingram too tonight. Warren, you still with us?
An opinion.
Ford says, were it not.
All right. Very bizarre things happening there. I do apologize for that. I think we will be able to get Warren Ingram back and just and sort of fix this. All right. I think we are going to leave things there as it stands. Let me just make a couple of points just to sort of sum up what Warren was talking about. And it seems to me that one of the hardest things to know is at what stage your business is at. And that, I think, is going to be the issue. All right, Warren, back with you. We were talking about, and we've just got a minute left.
Last year, the Gauteng government partnered.
All right. That's not Warren, I'm afraid. Sorry about that. Anyway, all right. So Warren Ingram was just wrapping up that conversation. It seems to me the hardest thing to know about all of this is really, how do you identify the stage of the business that you're at? And that maybe, I think, for all entrepreneurs must be the most difficult thing. And we've come across this, many times. We've spoken about it in other features too around small businesses. It's such an interesting question, though, for me, about how you keep your money separate and the idea of a market-related salary that you sort of pay yourself. I mean, I've known, obviously, for years and years that that's the way it has to be done. But I've always been very interested in the mechanics of how you decide that. And I think that's probably not that easy a thing to do. How do you decide what the sort of market-related salary is when it includes you? You're the person who's going to get it. Going to be very, very difficult.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the Absa Africa Financial Markets Index 2025.
Well, quick look at what's happening in the US. Gold on track, it seems, for its biggest one-day loss in about the last 5 years. And that really is, it seems, unexpected, if I can put it like that. But gold has been down by around 5% on the day. And that is, of course, having a big impact, as you know, on gold shares. So gold down very significantly. The Dow Jones is up 0.55%. NASDAQ is down 0.17%, and the S&P 500 is down just 0.03% at the moment. So that's what's happening on U.S. markets tonight. We, of course, will be back with you tomorrow. Good evening. It's 8 o'clock.